Okay, what if I told you that one of the most common bits of business advice in the UK is also one of the most dangerous? Seriously, we're talking about how long you need to keep your tax records, and we are about to bust a myth that could literally save you a fortune.
Now, we can bring you this crucial breakdown thanks to the specialists at ProTax Accountants. They've given us the straight-up, unvarnished truth about HMRC's reach into your financial past. So, let's get into it. So, let's picture this. You've done your bit, right? You've got 6 years of invoices, receipts, and bank statements, all filed away nice and neat. The clock ticks over into year 7. Is it finally time to fire up that shredder and get some space back?
The answer is a massive, resounding no. And the real number you need to burn into your brain is this one: 20 years. Yep, you heard me right. Under certain circumstances, that is exactly how far back HMRC can dig into your financial history. Stay with me because we are going to unpack exactly how that's even possible.
Here's our game plan for today. First, we'll totally dismantle that 6-year myth. Then, we'll lay out HMRC's actual timelines. The absolute core of this is understanding the difference between being careless and being deliberate. Then, we'll look at the crazy tech HMRC uses to spot problems, show you how to build a rock-solid record-keeping system, and finally, cover what on earth to do if that dreaded brown envelope ever lands on your doormat.
Right, let's get down to it. This so-called 6-year rule is everywhere. You've probably heard it from colleagues, maybe even your old accountant. And look, it's not totally made up, but relying on it is like using a sieve to bail out a boat. It gives you this false sense of security while you're completely ignoring the real danger.
And here it is. This is the absolute game changer that most people miss. HMRC's power to investigate isn't really about the date printed on a document. It's all about the behavior behind the numbers you put on your tax return. That single word is the key that unlocks everything, and it dictates just how far back they're allowed to go.
So what are the real timelines we're talking about here? Well, it's not one simple number. It's more like a sliding scale, and where you fall on that scale depends completely on how HMRC views your actions. Let's look at the official breakdown.
Now take a good look at this because it lays out the stakes so clearly. If HMRC thinks you took reasonable care but still made an honest mistake, the normal time limit is 4 years. If they judge you acted carelessly, it stretches to 6 years, and that, right there, is where the common myth comes from. But that's not all. Look at the jump. If there are any offshore matters involved, the window expands to a massive 12 years. And for what HMRC calls deliberate behavior, well, they get to investigate the last 2 decades of your life.
This brings us to the most critical part of this entire discussion. You see, the words careless and deliberate aren't just descriptions. In tax law, they are incredibly powerful legal definitions that determine everything: the length of an investigation, the size of the penalties, and frankly, how much sleep you're going to lose at night.
Let's kick off with a bit of good news. And this comes straight from the top. The head of HMRC, Jim Hara, has actually said that they know honest mistakes happen. So if you can show you took reasonable care, you kept good records, you used proper software, maybe asked for help when you needed it, but you still made an error, you will have to pay the tax you owe, but you won't get hit with a penalty. This is all about protecting people who are genuinely trying to get it right.
So what's the actual difference between being careless and being deliberate? This is what trips so many people up. Careless, well, that basically means you just dropped the ball. Think about a freelance designer in London who forgets to declare one small side gig, even though they have the invoice for it sitting in a file somewhere. It was an oversight, a failure to take that reasonable care. Now, deliberate is a whole other league. That's when you knowingly do something wrong. For instance, creating a totally fake invoice for a service you never paid for, just to slash your tax bill. One is a slip-up, the other is a calculated deception.
But don't for a second think that Careless is a get-out-of-jail-free card. Oh no, not even close. Penalties for careless behavior can climb as high as 30% of the tax you owe. To put that into perspective, you might remember the high-profile case involving the former Chancellor, Nadim Zahawi. It was reportedly settled on the basis that his error was careless and it resulted in a penalty payment said to be worth millions of pounds. It just goes to show how incredibly serious even a careless mistake can be.
And that brings us to the most serious category of them all: deliberate behavior. This is about making a conscious choice to ignore your tax obligations. It's knowingly underdeclaring your income, intentionally inflating your expenses, or hiding money away. HMRC sees this as a deliberate intention to mislead, and that's what gives them the green light to open up the books on the last 20 years of your life.
And the case of Milligan versus HMRC is such a stark warning that illustrates this point perfectly. The taxpayer had just stopped filing returns and admitted to stacking up unopened letters from HMRC in a room.
The tribunal ruled that this head-in-the-sand approach wasn't just carelessness. No, it was a conscious decision, a deliberate failure to act. And that ruling validated HMRC's 20-year assessment. Ignoring the problem doesn't make it go away. It makes it 1,000 times worse.
So you might be wondering, how on earth does HMRC even find these discrepancies in the first place, especially from years and years ago? Well, they have an unbelievably powerful digital detective working for them 24/7, and its name is Connect. The system is called HMRC Connect, and just to give you an idea of how effective it is, in the 2024-25 financial year alone, it was used to recover an estimated £4.6 billion in underpaid tax. That's about 10% of the UK's entire tax gap found by this one system. It's incredible. So what's it looking at? Well, think of Connect as a data mining behemoth. It cross-references the info on your tax return with billions of data points from other sources. What kind of sources? Oh, just your bank accounts, credit card records, property data from a land registry. It sees vehicle information from the DVLA, sales data from platforms like eBay, and your rental income from sites like Airbnb. It even pulls in information from the UK Border Agency and shares data with tax authorities in other countries. Basically, it builds a detailed digital picture of your entire financial life and flags any little inconsistencies for a human investigator to check out.
Okay, now that we understand the risks, let's switch gears and get practical. It's time to build your fortress. Let's look at exactly what you need to keep and for how long to make sure you are always protected.
This checklist right here is your new best friend. For general accounts, payroll, and VAT records, 6 years is the standard. But look at the details. For simple contracts, you need to keep them for 6 years after the contract ends, not from when you signed it. For a special type of contract called a deed, that jumps to 12 years after it ends. And did you know this last one? For certain health and safety records, like KOSH-HA assessments, you are legally required to keep them for a whopping 40 years.
Now here's a pro tip from the team at Pro Tax Accountant. With all these super long retention periods, does this mean your office has to be overflowing with filing cabinets and dusty old boxes of paper?
Absolutely not, and this is a total lifesaver. HMRC is perfectly happy with digital copies. As long as your scanned receipts or PDF invoices are clear, complete, and easy to read, and you're storing them somewhere safe and secure, you are good to go. Suddenly, keeping 20 years' worth of records doesn't sound quite so terrifying, does it?
All right, let's talk about that moment that makes every business owner's blood run cold. You get a letter from HMRC announcing they're opening an investigation. Your first instinct might be to panic, but the key is to stay calm and follow a clear, simple plan.
Here are the 3 non-negotiable steps you must take. Step 1, whatever you do, do not ignore that letter. It will have strict deadlines and you have to meet them. Step 2, preserve everything. From this moment on, you destroy nothing, not a single receipt, email, or scribbled note. And step 3, which is honestly the most important thing you can possibly do, pick up the phone and call a tax investigation specialist. Immediately. Don't even think about handling this alone. They know how to decipher what HMRC really wants, they can handle all the communication, and they will fight your corner from day one.
So let's quickly recap the big takeaways from all of this. First, the 6-year rule is a dangerous myth. HMRC can and will go back 20 years. Second, everything, and I mean everything, hinges on your behavior. Third, organized digital records are your absolute best line of defense. Fourth, remember that different documents have different, sometimes surprisingly long, retention rules. And finally, if HMRC does come knocking, your very first move should always be to get professional help.
And that really leaves us with one final, big question for you to think about. Knowing what you know now about the different timelines, about how crucial it is to prove you took reasonable care, about HMRC's digital detective, take a really honest look at your own system. Is it genuinely protecting you, or is it leaving you completely exposed? Okay, just before we wrap up, here's the important legal bit. The information we've shared here today is for general guidance only and is not a substitute for professional advice that's tailored to your specific situation. Please, before you make any financial decision, you must consult a tax expert.
For that tailored advice on handling a tax investigation or just getting your record-keeping system totally ironclad, we highly recommend you get in touch with the specialists who put this briefing together, Pro Tax Accountant. You can reach them on WhatsApp or by phone at 07985 689 912 or just drop them an email at info@protaxaccountant.co.uk. Thanks for joining.